It's time for your personal bank show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show, and today I want to talk about, well, debt. And now, I know for a lot of people that's not an exciting topic, but it's an important one. And I think this is important on a lot of levels, on a lot of reasons. First of all, again, I talked about in the last show about a lot about our rights, freedoms as a country, civil rights that we have, particularly the attack on the unprecedented attack I've seen on free speech recently. If you missed it, I'm going to recommend you go to yourpersonalbank.com. You can listen to any of the previously recorded shows and you can check it out. I really encourage you to do so. But the thing is, debt is actually one of those things that I've heard some people mention it this way, and I've certainly seen it, as something that really holds people back, holds them down. It's a form of bondage. The Bible talks about it. The debtor is enslaved to the oh geez, I just forgot what I was saying. The debt. You know what I'm trying to say. The borrower. The borrower is in debt to the debtor. So the thing is, debt can create a lot of stress, create a lot of frustration, difficulty in life, and sadly, not always, but many times debt can be kind of self-imposed through bad financial habits. And financial literacy is at the root of a lot of this, where it's a problem where people, keeping up with the Joneses or doing, trying to live their lifestyle they did as their parents did, but without the income, there's all kinds of psychological reasons behind it and things like that. Paying off debt is not easy, but it is part of, like in the Declaration of Independence talked about life, liberty, and the pursuit of happiness. Part of that pursuit of happiness is economic freedom. Okay? Money isn't the most important thing in life, and I'm here as a financial person to tell you that. But I can say this. My wife said this to me a number of years ago, and it was so true. I've been an entrepreneur pretty much my entire life. I started off, after I did the military thing out of high school. Then I went to college. Got a job, got a degree, an agriculture degree, crop and soil science of all things. Ended up going to work for the federal government. I lasted 6 months because I absolutely I found it stifling is the best word I can think of. Stifling in terms of creativity or anything else for that matter. And it just, I felt suffocated. I knew I was in the wrong place. So I got to the point where I said I was willing to flip burgers at McDonald's versus doing that I couldn't just see doing that for the rest of my career. So I knew it was time to get out, moved to Arizona, bought a retail business, went well for a while. Then I got hit by a Gulf War, economic problems, and learned a lot of lessons from that. Then have started a couple other businesses since then, a contracting business. I was a contractor for a while. That was going well until I got in an accident, 2 back-to-back car accidents through no fault of my own. I got rear-ended twice a month apart, and it messed my back up. The second one in particular, and I just wasn't able to physically do the work I was doing with the crews, and so I knew I had to do something else different. I remember laying there. I was a sprinkler contractor. Doing commercial residential sprinkler work, and we were trying to get a job done because I'd gotten behind because I'd gotten injured with my crews. I'm laying there trying to glue pipe, and I remember laying there. I would glue pipe for 5 minutes, lay on my back and stretch my back out because it was just hurting so bad. I remember looking up at the sky and just saying, God, I've got to find something else. I just knew it. I just knew right then and there I couldn't keep doing what I was doing. So that's how I got into the white collar world, and that's how I got into the financial world and started financial agency. Been doing that for the last, almost 25 years. So, and then a couple of years ago, and got in the process of starting, and we're in the process of opening a FDIC insured bank. So it's kind of related. Obviously did some real estate investing in the meantime too, had a real estate investment company. So I've done a lot of different things in the entrepreneurial world. I'll put it that way. And there's certainly opportunities as an entrepreneur to really succeed, and there's ups and downs. I mean, there's no question. And I remember my wife said, to make a long story short, she said to me, money, there's been times in our lives we've had a lot of money, and there's times that we have not. And she goes, money doesn't make you happy, but it certainly eliminates a lot of stress. And I guess that's the biggest thing is our country is under unprecedented attacks on our freedoms, particularly freedom of speech, that I've never seen in my lifetime. And the thing is if you're going to be a patriot, if you're going to be someone who is living the life the opportunity that you have, one of those things is you have to have some economic freedom. Okay? Now, I'm not talking about where you have to be, not working like the FIRE movement and things like that. If that's your cup of tea, fine. I have nothing against people getting out financial independence, of course. Getting out of debt is part of it. But again, until you're in a position where you're not under the servitude of paying a creditor, you don't know. It's really freeing to be debt free. How's that? And that's something my wife and I have accomplished ourselves. It's a long story. Won't go into it in detail at the moment. But we've been able to accomplish that. And a big part of that is your personal bank has helped us accomplish that because we can pay off debt and we can pay it off faster. And it's the fastest way I've seen to do it. And there's other ideas on how to do it. I'm going to share with you how your personal bank can actually enhance those other ideas in paying off debt. So like I said, one of your first goals should be to be as debt-free as possible. Now, that sounds on the surface next to impossible in our society. But let me delve into this a little further. When we say debt-free, what I really mean is you got to understand the difference of strategic debt versus consumer debt. Now, there's a difference. In other words, strategic debt is sometimes known as good debt, and that's where debt payments are made from someone else's efforts or an asset. And a common example is, say, you owned a rental property where the income is higher than the expenses. So in other words, you have a positive cash flow. And my question I ask people all the time is, can you build wealth that way? And the answer is absolutely. So with our historically low interest rate environment we're in, particularly, there are opportunities to build wealth through strategic debt. Real estate is one example of those that most people are familiar with, okay? Now, bad debt is consumer debt. And that basically is any payment made by your efforts. In other words, if you have to go to work to pay the bill, that's bad debt. And that's the type of stuff you want to get rid of as quickly as possible. Obviously, it makes sense financially to pay off the highest interest rate debt first because that's going to make the most impact positively, obviously, in reducing your debt. And there's a few things about debt to understand. Credit card payments, depending on your interest rate, even today where they're lower than average, do you realize if you just make minimum payments on a credit card bill that you could pay up to 20 years to pay it off and pay up to 4 times the total dollars for that item? See, I love it when people say, hey, I got this on sale, but they use their credit card and they're making minimum payments. No, you didn't get it on sale. You actually paid 2, 3, or 4 times more for it than you would have if you paid cash or paid for it up front, wrote a check or whatever, right? So the key is getting rid of consumer debt. And there's a book many of you have heard of. It's called Rich Dad, Poor Dad by Robert Kiyosaki. And this is not from me. This is from him. This is a concept he teaches in the book that I think, and not everything about Robert Kiyosaki is great. Don't get me wrong. Whether you agree or disagree with him, that's not the point here. But this is one thing that he teaches that I believe is really extremely powerful and valid. And that is, he teaches that an asset, if you define an asset as something that feeds you or provides income, and you define liability as something that eats you or as an expense. Now, so you need to understand something. Most CPAs and financial advisors don't understand this concept. And here's what I mean by it. If you're ever doing a financial statement and you have your personal residence, let's say you own a home, what column does a CPA or financial advisor typically put your home in, your personal residence? The asset or the liability column? And every financial statement I've ever seen, they put it in the asset column. Now, based on Robert Kiyosaki's definition, is your personal residence, is it an asset or a liability? Well, does it provide income? Does it feed you? And in most cases, the answer is no, right? Now, if you have a rent or a boarder, it might. But if outside of that, your personal residence is not an asset. Now, can your residence increase in value over time? Certainly, that can happen. But here's the problem with that. When do you actually take advantage of that? There's two ways to take advantage of an appreciation of a property. That is, you sell it and move to something cheaper, which actually is the opposite of what most Americans do, right? When they move, what do? They tend to move to something bigger or more expensive. Okay. Or the second thing is you borrow, use it as an asset, you borrow against it. Now, the problem is if you borrow against it, like taking out a home equity line of credit or something, you literally create another debt, more interest. Okay? So my point is, I'm not here to make people feel bad, but what a lot of people don't realize is if they're really trying to grow wealth and change their financial future, the first step is understand where you're at. Take a hard, solid look at where you're at. We do that all the time with Your Personal Bank. Contact us, yourpersonalbank.com. I'll be happy to talk to you about looking at your situation financially. Where are you really at? I'm not going to blow smoke up your, I'm not going to blow you smoke, okay? I'm going to tell you where you're at. And why is that so important? Well, I've fortunately never had to deal with this, but if you're an alcoholic and you go to the 12-step program, what's the first step of the 12-step program? And almost all of us know that, and that is admit you're an alcoholic. Now, if you've got a debt problem, the first step to solving it is admitting you got a debt problem. And if you're using, maybe many people think what they consider their largest asset, or they think it's their largest asset, is really a liability, is that really solving the problem for folks? You see what I'm trying to say is, do we want to make a difference or not? And one of the things I say to folks all the time when I meet with them, like I said, I encourage you to contact me, yourpersonalbank.com, to do that. But I say this with a smile, but it's true. I said, do you want me to tell you what you want to hear, or do you want me to tell you what you need to hear? See, there's a big difference. Again, do you want to make a difference in the future? Do you want to get rid of consumer debt? Do you want to change the financial future for you, your family, and make a difference? Do you want freedom? Do you want to get out of control of the creditors and debtors that are out there that you owe? See, that's part of being free. It's part of having freedom as an American, is reducing and eliminating that consumer debt. And there's a lot of things we can do with that to help folks in using Your Personal Bank and enhance that. So stay tuned in the next segment because we're going to talk about that even further.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to Your Personal Bank Show. And I'll tell you what, today we're talking about a fun topic, and that's debt. I know a lot of people don't like to talk about that one. But it's important. In fact, I find for the average American that I deal with, and like I said, I've been in the financial industry now close to 25 years. I think it's 23rd, 24th year. And probably the most common thing I deal with when I'm talking to folks about planning for retirement, or they're in retirement, or planning for the future in any way, one of the biggest issues we run across most commonly is debt, and how to address debt, how to minimize debt, how to minimize the interest. Because here's the thing. If you're paying interest to a creditor, that's money going out of your pocket, isn't it? And it's not benefiting you, certainly benefiting them. Okay. And like I said, I've got a lot of experience with this. And also as I'm the chair of the board of a bank in formation as a banker. Okay. What are banks' primary function in life? I mean, what do they really do? How do they make money? They provide loans to people, houses, cars, credit cards, whatever, you name it. They're a creditor. They have money and they loan it to you and charge you interest, right? That's how banks make their majority of their profit. Okay, so I understand the creditor-debtor side, and I want you to understand something. You don't need to feel sorry for them. They're doing just fine, okay? I'm going to share with you in a bit how much money banks and creditors and lenders really make on the average American, and for most folks, it's shocking. But basically, the U.S. Census has told us, come out for a while now, that the average American, this is how they spend their money as it comes in. we pay about 30% of our income on debt payments. That's interest and principal. Okay, that's the average American household. We pay 40% of our income on taxes. That's federal. Income, property, gas. When we go shopping, we pay taxes on all this stuff, right? It adds up to about 40% for the average American, by the way, all the different taxes. There's about a 5%, it's actually about 4.5% nationally, average savings rate. It's gone up a little bit this past year because of COVID and some variations, but about 5% is pretty average, which leaves about 25% left over for lifestyle. And the average American is wondering why they're struggling. If 70% of your income is going to service debt and taxes, think about it, okay? How do we address this? How do we minimize it? Well, there's two ways. One, let's shrink the debt. Let's shrink the interest you're paying. That means you'd have more money, right? Also, let's reduce the taxes. There are legal ways to go about it, reallocating investments and funds and things like that you can do. Your personal bank's one of those key ones where you can actually reduce your overall tax liability. And it's perfectly legal to do so. So why do I talk about debt so much? Well, according to the U.S. Census, the average American earns about $1.8 million in their lifetime. The average American actually pays about $280,000 of interest in their lifetime. Not principal, interest. Now, that basically adds up to about 15% of your total lifetime income. Didn't I say earlier, don't feel sorry for the creditors and lenders? We're voluntarily giving them about 15% of our gross earnings, our lifetime gross earnings, the average American is. What if you could cut that in half? For a couple, that's over $500,000, right? $280,000 of interest per person. So a couple, that's well over $500,000. What if you could cut that in half? I don't know, when an extra $250,000, $250,000 in your pocket in retirement, would that make a difference? I think for most people, that answer would be yes. Okay. And by the way, it's not just the interest you're paying out, but it's what that money could have done over your lifetime. Look, if you're paying over $250,000 of interest out over your lifetime on interest payments, what if instead you had taken that money and invested it? Do you think you could make it grow? Over your lifetime, could you increase it 2 times, 3 times, 4 times even, maybe more? And the answer in most cases would be yes. So really, if you think about it, and the studies show that the interest earned that lenders earn from us, each of us, they then turn around and reinvest it. And so the lenders are earning over $1 million per person over the average person's lifetime. That's the difference. We're talking about $1 million, one way or the other, and you get to decide who makes the $1 million. You or the lenders. Now, if you want it to be the lenders, keep doing what you're doing. Don't change a thing. But if you want some of that to come back to you, what if you could get half of it back? What if you could just get a quarter of it back even? Again, would $250,000 or $500,000 additional for retirement make a difference per person? I think the answer is a strong affirmative. So how do we do this? Well, actually, it's really, really quite simple. I had a listener actually reach out to me yesterday. It was pretty cool. And they were talking about purchasing an RV. Okay. And that's awesome that they're in a position they're going to be able to do it, and they're going to finance it. That was the plan because they got really good credit. And I looked up what current RV lending rates are for someone with good credit, and they're probably in the, they're 4.5. I saw 5 probably, somewhere in that range. Okay. So here's the thing. How does your personal bank work, and how would it help this person with looking to purchase an RV? Now, here's what I want you to understand. It doesn't have to be an RV. If you're financing a car, a house, or any other asset for that matter, it doesn't really matter, okay? What I'm going to do, and you're going to have to stay, what we're going to do is stay tuned in the next segment so I have a chance to really explain how this works, is I can show you how to reduce the financing costs of purchasing that RV or that car or that house or, well, anything else for that matter, any item that you would finance, okay? Because see, here's the thing. When it comes to purchasing an item, you really have, a large ticket item. You have two choices, right? Most people understand they have two choices. You can pay cash for it if you have the funds, or you can finance it. Well, what I want folks to understand is there's a third option that most people are not aware of, and that's using your personal bank. The problem with the first option of paying cash for an item, let's say this gentleman purchases the RV with cash. The problem is those dollars used to purchase that item, of course, he gets the item, gets the RV, gets the house, gets the car, whatever. But those dollars are gone forever, right? In other words, you traded the dollars for the item. Will those dollars ever earn any interest for you in the future, ever again? The answer is no. You traded them for an item. So what could have that money done if you're going to pay $40,000 or $50,000 for a car, let's say, or $100,000 for an RV, or $250,000 for a house, or more, whatever it may be, $500,000 or more? If you paid cash, instead of paying cash, could that money have grown? Could you have made more from it over the next decade or 2 or 3 or more? And in most cases, the answer is yes. And what they said, your personal bank, we have companies paying 6% dividends even today and have paid that for the last 25 plus years. So you could even get, say a 5 to 6% return with guarantees, tax free, with a long track record in history. We'll talk about more options on this and how it makes more sense to, take the third option versus paying cash or financing. So stay tuned.
For more information on your personal bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to Your Personal Bank Show. And today we've been talking about a very fun subject, and that is debt. Like I said, I know a lot of people don't talk about this or don't want to talk about it, but it's a very, very important topic to discuss. In fact, a lot of the information I've been sharing comes from a college-certified financial literacy course that I've previously taught. I haven't done that in a while, but it's taught at a few colleges. I wish it should be taught everywhere, frankly, because financial literacy, basic financial literacy, I find is unfortunately very uncommon. It's not taught in schools. It's not taught in universities. Unfortunately, it's not taught in the homes much anymore. Traditionally, it used to be something that was, Dad would teach the kids growing up, about basic financial literacy things, like how to balance a checkbook and budgeting and various things like that. But it's one of those things that it's been hijacked. And I think there's a lot of reasons behind it. Wall Street's kind of taken that role, and it's just become not popular to discuss. But again, as a parent, I'm a parent of 2 teenage daughters. We talk about it. We talk about it regularly. Now, obviously, it's what, Dad does. They've come and they listen to the radio station show sometimes and learn things from it. But even before I did the radio show, when the girls were younger, we taught them basic budgeting and financial literacy tools because, it's a necessary skill that's needed. It needs to be discussed. It needs to be talked about. And if you haven't had that opportunity and you weren't blessed with that growing up like I wasn't, my wife wasn't, hopefully we can be a resource for you. But like I said, I've talked a lot about debt and how to get out of debt, because the other big picture part of this is, look, if you're a patriot, if you're an American, and you want to take advantage of the American opportunity that this country stood for, this was founded on, the very principle is founded on, one of the things you need to do is not be slave to lenders. I mean, you're a slave to the creditor, to the lender. And you want to be out of underneath that, because that's not. Economic freedom is part of that life, liberty, and pursuit of happiness. It's in the Declaration. Okay, folks? I didn't say it's easy. Freedom's not easy, but freedom's rewarding. And I would just want to encourage anyone who's facing debt, or struggling with debt, or wants to see a better way of getting out of debt, contact us at yourpersonalbank.com. We can show you how to get out of debt faster, and accelerate the whole process. How do we do it? It's really quite simple. See, Your Personal Bank is a 2-step process. It's where we set up a high cash value policy that's established to maximize tax-favored growth. Well, I said earlier, we have companies that have been paying 6% dividends even today and have been paying that over the last 25 plus years and never missed a dividend since literally before the Civil War. So these are long-term, consistent dividend-paying companies. The next step is we set up a bank line of credit established using cash in the policy as collateral. Now, when I'm talking about paying off debt, and then I turn around and say you set up a bank line of credit, that can sound counterintuitive. But here's the key. The lines of credit are less. What they charge is less than what you're earning in the policy. So currently, you can earn up to 6%, as I stated earlier, in dividends in the policy. When you access funds from the bank line of credit, they're charging in the threes, between 3 and 3.95, depending on the amount of funds we're dealing with. Now, here's the key. If you fund the policy, you put money in the policy, then you turn around and access the funds, if you're getting credit at 6%, you're getting charged in the threes, what's your money doing? What's happening? Well, you're still making money. You're keeping the difference. You're keeping that 2 or 3% difference, or positive arbitrage is what it's called. Okay? You're still making money on money you spent. Now, let's say we use that money, as we stated earlier, to pay down debt. See, if you have debt, when you pay the money, you pay the payments on the debt, whatever the debt may be, those dollars, do they ever earn interest for you in the future? And the answer is no. They're gone forever. What if you put them in the policy, accessed them from the bank line of credit, and then paid off the debt? What would happen? Well, you'd still pick up 2 or 3% positive arbitrage. In other words, the money you use to pay down the debt would still earn some for you. Now, 2 to 3% may not sound like a lot, but add that up over a decade or 2 or 3 or more even. And what if you have $10,000 in debt? What if you have $100,000 in debt? What if you have $1 million in debt? What if you capture 2 or 3% positive arbitrage on that debt as you paid it down, but kept that and continued to earn that the rest of your life? Would you have more money in your pocket? And the answer is yes, absolutely. Now, when it comes to purchasing items, I started to talk about this early in the previous segment. If you missed it, go to yourpersonalbank.com, listen to the previous, so you can listen to any of the previously recorded shows and check it out, or contact me and be happy to talk to you about this further. But again, the key is, I was talking about this gentleman who's looking at purchasing an RV. Okay? It doesn't matter if it's an RV, a house, a car, or any other item for that matter. If you're looking at financing it, you typically have 2 choices. You either pay cash or you finance. Well, there's a third choice, using the personal bank. Some of you have already figured it out. See, if you pay cash, you give up the dollars, then dollars can never earn for you in the future. So that's not good. If you finance, you give up the dollars and you pay interest. Again, there's a third option. Stay tuned to the next segment. I promise I'm going to share it with you.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. We're round and third. Today we've been talking about debt. And again, I know it's not a fun subject or topic, but it's really, really important one. And I've stated in the previous segments, look, if you want to enjoy the freedoms that this country has to offer, if you want to be in the land of opportunity, life, liberty, pursuit of happiness, like our founding fathers, intended, debt is something that you've got to get under control. Otherwise, you're just not truly free. Okay? Now, again, understanding the difference between consumer debt and strategic debt is important. Strategic debt, in a nutshell, is where somebody else's efforts or asset is making the payments. You can build wealth that way. Great example is rental properties. That's one most people are familiar with, where you rent properties out and you earn more than your rentals are more than your mortgage payments, your expenses. So you can build wealth that way, can't you? And absolutely. But it's the consumer debt that really hampers people. And this, again, is debt that's based on your efforts. If you have to go to work to earn the money to pay the bill, that's the kind of debt you want to get rid of, because that's what can hurt you. And frankly, I've seen people in the higher income levels or lower income levels struggle with the same thing. It doesn't matter. It doesn't matter if you're a doctor or a dentist or an attorney or something and you have high levels of debt, because you still have to go to work to pay it off. If you're lower income, it's the same thing. If you have to go to work to pay it off, that's the kind of debt that gets you in trouble. Why? What if you can't go to work? What if you aren't able to earn? What if something happens economically or personally? My gosh, did 2020 teach us anything? It should have taught us that you got to be prepared for emergencies, right? or unexpected situations or economies. What if something happens personally, you get injured or something like that, or your health, you get whatever, and your job or you get laid off, or your business gets shut down. Sound familiar? All of a sudden your income just drops, but yet you still have the debt. That's where the problems come into play with consumer debt. That's why you want to address it. Now, we talked about, like I said, contact us at yourpersonalbank.com. We can structure a plan that, here's the thing I like about doing it with debt and paying it off. And I know there's a lot of folks who, are familiar with many people out there who educate on paying off debt, like Dave Ramsey and various others. And in terms of paying off debt, again, I'm a big fan, okay? Now, you want to be able to do it in a manner that makes sense. And what I find is if I can restructure somebody's financial situation where it basically, it's amazing how often I can restructure the situation where the amount of money they have coming in to use, to live on, doesn't change. We're just reallocating different things and moving it around so we're knocking down the debt instead of increasing the debt. I can't tell you how many times I've helped people do that. Hundreds of times, literally, in my career. So in other words, nothing in your lifestyle changes, but now your debt's going down. Your personal bank can help accomplish that. And you're earning more money. You're earning money even on the payments you're making. You're earning interest on it. And I'll explain that further in a minute. When you can structure it that way, where it doesn't really require any lifestyle changes, nothing in your life really changes, but now your financial picture is getting better over time, those overwhelmingly are success stories. And over time, those people end up getting out of debt. That's what my wife and I did. We did it over about a 5-year period. We had tremendous levels of debt. Some we had to negotiate, and some we wrote off, and some we were able to pay off. And it was a combination of all the above because we had some business debt, real estate debt. We had all kinds of different things going on from the 08-09 Great Recession. I always tell people, look, if somebody told you everything they've done has worked out wonderfully and they never made any mistakes, either that person's never done anything or they're lying. In fact, you learn from your mistakes. You learn those. You never forget those lessons. You know what I'm saying? Anyway, my point is this. To structure a plan that requires the minimum amount of change to your lifestyle is the one that's going to be most likely to succeed. And we work with folks on that all the time. Contact us at yourpersonalbank.com. We'll be happy to help you with that. Now, the second thing is folks buy stuff. And when you're buying big ticket items, things like cars and RVs and houses and various things like that, most folks are faced with two options. That is, pay cash or finance. The problem with paying cash, well, by the way, there's a third option. I talked about it briefly in the last segment. I'm going to go into further this time. First option is pay cash. Well, pay cash, the thing is, you don't have any interest you pay. That's good. But the dollars you gave to purchase the item are gone forever. They can't earn for you in the future. It's called lost opportunity cost. In other words, what could have that money done for you if you had instead invested it or got some interest back on it over time, over your lifetime? So in most cases, I find that's not the best option, nor is it even feasible for a lot of people to dump $50,000 or $100,000 or several $100,000 on a house, for example, cash. So then they go to financing. Now, the problem with financing is, I told you folks, I'm on chairman board of the bank. Banks are doing really well lending money to people because you not only pay whatever the purchase price is for that item, that house, that car, that RV, whatever it is, but you now also pay the interest on top of it. So you're paying more for the item than it actually than the purchase price. And sometimes you'll pay 50% more or even 100% more depending on the interest rate you're talking about. You can end up paying quite a bit. So if you buy an RV for $100,000 and even at a 5% loan, you could pay $125,000 or $150,000 or more with good interest rates. With mortgages, I've seen situations where people will pay, twice on a 30-year fixed mortgage. Not so much lately because the interest rates have gone down some, or a lot, I should say. But the reality is you pay a lot more for the property than the purchase price was. Okay? So financing, generally speaking, from a financial standpoint, is not a good way to go if you can avoid it whenever possible. Now, there's a third option. Let's say you want to purchase an item, you want to buy a house or whatever. You don't have the cash to pay. You don't have the money to pay cash, or you don't want to allocate those dollars and give them up and give up the ability for them to earn. So you're forced with financing. All right, well, what your personal bank can do is it can reduce the cost of financing. Let me use this RV example because this listener reached out to me on this literally yesterday. And it's this. Well, if your interest rate on that RV loan is, say, 4.5%, 5%, with good credit, that's probably the range it's going to be today. It's car loans, you can get a little bit lower. House loans, certainly lower. You can get in the 3s. I've seen even 2s, okay, if you got good credit. But here's the thing. If you use your personal bank, if you put the funds in the policy, then you turn around, and remember, you're getting credited somewhere in between 5 and 6% dividends, and you then access the funds through the bank line of credit, and you're getting charged between 3 and 3.95, depending on the amount of funds we're talking about. You're picking up a 2 to 3% positive arbitrage there, aren't you? Because remember, when you access the funds, are you taking them from the insurance company or the bank? And the answer is the bank. The funds are still in the policy, still earning interest or earning dividends, right? So if you're picking up that 2 or 3% difference, you're keeping the difference. That's called positive arbitrage. And let's say you had a 5% loan. And let's say you picked up 2.5% positive arbitrage. Well, didn't we just cut your interest rate, your financing in half? Your net result would be, instead of paying 5% interest, you're paying 2.5%. You cut it in half. I have folks today who are getting 3% positive arbitrage on their personal bank, and they're using the money each month to pay the mortgage payments, and their interest rates on their mortgage is, I got one client not too long ago, refinanced 30-year fixed mortgage at 3.25%. And their positive arbitrage on their policy, between their policy and the bank line, is 3% positive arbitrage. So every time they take money from the bank line to pay their mortgage, they're keeping 3%. The interest on their mortgage is 3.25%. So what's the net effect, the end result of their interest cost on their home? 0.25%. We almost completely wiped out the interest on their mortgage. Now, by the way, folks, the difference for them over 30 years, several $100,000. Would they rather have, it's between $200,000 and $300,000, it's about $250,000. The point was, do this and keep $250,000 in your pocket in the next 30 years, or give it to the lender. Which one would you prefer? See, you get to choose. That's the beauty of this. So whether you're buying a car, a house, an RV, or any other item for that matter, and you're going to finance it, okay. If you decide you're going to finance it and you have to finance it, that's your only choice. Why not reduce the cost of financing? I mean, let me go back to the RV example with this listener. If you had two dealers and you were going to buy this RV it's the same model, same make, same year, same everything, and the interest rate on one was 5%, the loan, and the other was 2.5%, and the same purchase price, same everything, like I said, which one you buying? See, that's the net effect of your personal bank. And the last thought is, I had another longtime listener reach out. I was talking to him a couple of days ago, and he said, I really love what you're teaching. I think it's awesome, and I can see where we could use this personal bank after you've paid off the debt, like Dave Ramsey talks about. And I said, no. Actually, sometimes we call this Dave Ramsey turbocharged. I don't know, but we're accelerating it. We're actually speeding up. If you're applying that debt payoff, that snowball effect of paying off debt, by using the personal bank and picking up the interest, the positive arbitrage along the way, you can actually accelerate the snowball even faster. We can show you where your debt payoff will even be quicker than just strictly using the snowball effect to pay off the debt. Look, the snowball effect, the avalanche, whatever you want to call it, to pay down debt works. We apply that. It absolutely works, and those debt payoff folks are absolutely right. But all we're doing is we're adding positive arbitrage to the picture, and now what we're doing is we're accelerating the whole process. We're paying it off even faster, and then ultimately what ends up happening down the road, you have more money in your pocket. That's the bottom line. So again, I'm just going to encourage folks, if you want more information, You want me to look at your situation and share with you how we can reduce your debt, reduce your taxes. By the way, does anybody think taxes might be going up in the future, particularly with the current administration we now have? If you think taxes are going to go up in the future, having tax-free options is going to become even more important. But you want to knock down this debt and you want to accelerate it and have more money when it's all said and done for retirement and various things like that. Well, then contact me, yourpersonalbank.com. By the way, I encourage this all the time too. If you just have a question, like this listener did, shoot me an email, contact me, whatever, and you want me to answer the question on the air, I'll be happy to do that. Most of the scenarios I deal with clients on a daily basis with this. I share with them how this works. I have clients I've worked with for years and years. I use this tool personally. We use it for our personal and our business, and it works. So whatever your scenario is, whether you're looking to pay off debt, accelerate the debt payoff, or use it to purchase items, reduce the cost of purchasing, reduce the financing cost of purchasing items, or, and I didn't even get into this today because I just didn't have time, maybe next show we'll do that, is how do we increase the return on investments? If you're going to invest in something, how do we add to it? Take the same dollars? Well, the short story is, the nutshell is, Your Personal Bank can do that. I've talked about that in previous shows, so if you want to go to yourpersonalbank.com and look into it, be happy to do so. Or again, contact us for more information. The bottom line is, what's exciting is we dramatically, over a period of time, change the financial future of folks. And we help them achieve financial freedom, which again is one of those freedoms that's inherent that we have as citizens of this country: life, liberty, and the pursuit of happiness. And it's one of the things I often like to say, as long as it's still on our coins, I just want to say, in God we trust.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.